Hi, good morning. It's so wonderful to see all of you here for a topic that's evolving quite fast, faster than people can keep up with, the evolution of financial integration. Initially, this panel, as you've just heard, was quite investment heavy. We're going to shake it up a bit because we have a really good mixture of speakers here today. As you know, PSD2 came here and enabled open banking. With that, we have real-time payments like SEPA Instant. We have account-to-account solutions like Wero. And then we have blockchain solutions that allow cross-border solutions. And at the same time, we have AI shaking up everything, especially in finance. It's reshaping risk, fraud, and customer experience. And with all of that, I'm really glad that we have our panelists today because they're bringing their expertise from open finance, embedded finance, cryptography, blockchain, governance, commercial. So we have a bit of everything. Did I forget anybody? No, that's all. Okay. But let me first introduce you our speakers so you get an idea as well of who we have here. First, we have Anna Mai, CEO of Bridge API, with more than 20 years of digital experience in digital payments, open banking, and fintech innovation across Europe and Middle East. Then we have Dr. Theodosis Mourouzis. I'm going to call you Theo. Yeah, Theo. CEO of Electic Consulting, a cryptographer and security expert working at the intersection of cybersecurity, cryptography, and blockchain technologies. Then we have you correctly? Yes, Isidoros. Isidoros Mezopoulos, Chief Commercial Officer at Deepoget, with a long career across MasterCard, TCS, Oracle, and a deep understanding of commercial strategy and payments in Europe. And then we have Chrysovalantis. I'm going to call you Valandi. Valandis Koutsoumpos, CTO of XValley Europe, leading the technology that bridges traditional finance with the digital assets economy. And lastly, we have Yiannis Menelaou, Executive Director at XValley, a leader in blockchain adoption, governance, and ecosystem building across Europe and Asia. Thank you for being here. Are we ready? Shall we start? Yeah? Oh my God, that's a hard crowd. Okay, let's wake them up. So to begin with, first, I'm going to navigate you through 3 chapters. We're going to begin with where we are right now, what has happened in the past couple of years. Then we're going to look at risks and challenges. And then we're going to finish with opportunities and where the money goes, which was the initial description of the panel. So let's begin. And Anna, I'd love to begin with you. PSD2 unlocked open banking opportunities, and from your perspective, because you are building exactly there, what has been actually achieved, and where are we kind of behind?
Thank you, Maria, and hello and welcome, everyone. It's a pleasure to be with you today and to share my perspectives. And yes, it's been a journey, because I remember the first PSD and then enabling the financial markets and, of course, access to financial markets, to banking services and to payment services for third-party players, so non-banking, non-financial players. And then, of course, PSD2 that really enabled open banking, at least from the regulatory perspective, because it was a little bit forced. As you know, Europe is very much regulatory-driven. It's not self-regulated, market-driven initiative. So PSD, and of course now we have a trajectory towards PSD3. But I wouldn't like to really focus on the regulatory aspects, because I'm a practitioner. I've been in industry for 25 years, and I've seen the journey from like enabling financial services through open banking and now through open finance. So of course it's not easy to say what was the journey about, because it's been some years. Even like the last PSD2 is 2019, yeah, so it's been almost 7 years. But yes, we opened access, we enabled access to banking APIs. But what is most important, because I was always referring to that, this is not that we have access to APIs and how many APIs we can aggregate or we can extract data based on, but this is the use cases that can be created based on the API. So I think that's the first principle, which is obvious now for any single third-party provider. And also to explain, because I'm a CEO of Bridge API, which is a fintech based in Paris, France. And so I don't represent the banking side, so the data producers. I do represent the non-financial, non-banking players, so third-party providers, TPPs, that we are able to use these open banking benefits. And of course, we are data consumers. And what we do, based on the APIs, and we have 100% coverage in France, we are also in Germany, in Italy, in Spain, in some of the selected European markets. Based on the data, of course, this is like a simple account aggregation, but we are going beyond that. It means that we are using the data based on a simple account aggregation, account information to enable SMEs to have access to financial services. So I think this is exactly the trajectory from open banking to open finance. By open finance, we mean that it's not only banking data and banking APIs, but also like other financial products like credit and lending is particularly of an importance. And
that's not here yet, yeah, right?
We are already there. No, it's not. Regulator speaking, it's not. So because this is covered by PSD3, but that's why I'm referring that I don't want to be focused on the regulatory aspect, because of course we are there. We have access to these financial services because what we do is data enrichment. And one thing is what is like being regulated, but the second thing is, and of course there are like many aspects, what is really like possible based on the practical approach from financial players. And also we have APIs which are not open, public, but also premium APIs. And we can have access to the premium APIs. It's a common practice for banks in some of the selected geographies in Europe, that they also provide premium APIs. Premium, it means that it's going beyond the scope of PSD2, beyond the scope of the public APIs, but also in many cases, it's because open APIs are free of charge, but premium APIs might come with a cost. And I will stop here because I think this is like opening the perspective, and there are so many use cases to share and to talk about. But in terms of the trajectory, definitely we are pushing beyond banking. And I will stop here.
Out of curiosity, because you mentioned premium APIs, and I haven't heard of that before. We don't have that in our banks in Cyprus, right?
Not really.
Okay. Okay. Actually, Isidoros.
Yeah, I wanted to add a few things on top of what Anna was really talking about. So first and foremost, I share more of the same years as you do in financial services, fortunately or unfortunately, which means that I have firsthand witnessed on multiple occasions, banks don't really cooperate in terms of open banking, so not really providing the open APIs, and not really having that openness in terms of PSD2. So that was a de facto state. Mind you, it still is, not with systemic banks across Europe, but with some banks, smaller institutions for sure. That's the same case in 2025, 2026. So that's the first thing. Second thing that I want to build upon what Anna was saying regarding the use cases. So for me, obviously PSD2 laid the groundwork. PSD3 would actually be the kicker for open banking and open finance. And I mean, we're quite fortunate because we can look at what has happened since 2015 that PSD2 was first introduced till today, that unfortunately, the use cases are not really there. And because in the pocket, we cover AIS and PIS services across the whole continent, we do see that, especially in the south, open banking is nowhere to be found. In the Nordics, or in some instances in Central Europe, indeed, there are use cases where we do see a lot of large retailers starting to think about as PIS, or payment initiation, an actual payment, mind you, as a valid way to do checkout. But I mean, when the whole thing started, you really got a boatload of companies trying to leverage AIS to get information from banks, but did it lead anywhere? Not really. And this is the unfortunate part for open banking. But yeah, PSD3, I think it will be the kicker. I think that together with a lot of other things factoring in, like instant payments, it will strengthen open finance and open banking. And by the way, I will quote some ECB data just to, to make things a bit more tangible. So according to ECB in 2024, for non-cash transactions, card payments were something like 57%, okay? And credit transfers, which is bank transfers, were 22%, okay? This is non-cash transactions, okay? Card payments, this is volumes. In terms of actual money moved, card payments moved 1.7 trillion. Do you know, guys, how many trillions were moved with credit transfers? 100. And this is what open banking is tapping into. Okay, so that's my 2 cents.
Thank you.
If I may quickly, only like just to refer to what Isidoros said, because I'm very aligned with the banking approach, because yes, we are talking about open banking and open APIs, and of course they are being provided by data producers, by banks, and this is, I think, everywhere in Europe. So of course there are much more developed geographies like UK. UK is leading on open banking. France is also like, for the continental Europe and the fintech, that's the #1 market, and of course it's very much developed already and penetrated in terms of IIS and PIS. And the Nordics you mentioned, couldn't agree more. But having said that, banks are still not very like 100% or fully happy with providing the banking APIs. And of course, we face it as a provider, as a TPP, all the challenges. And of course, like the APIs are either not reliable, they are not replying. And now we have also some other like limitations also related to VOP, like verification of the payee. So there is a lot to be done. But having said that, we also, because we are in the business almost 10 years, but of course, like before it was like screen scraping, not like open APIs. But what we really mastered is our own capacity and technology with API management. So we know what banks are like, just we have like the scoring or rating of the bank's APIs. We know how to bypass them or how to replace them. We have the internal API knowledge and we have the software to do that. So we can have some alternatives and we can replace some of the banking APIs with other. So of course we have some like kind of art and science around it, which is very important. And we also have some alternatives like premium APIs, which are not very common. But of course, once we have the APIs established with the banks, they know us, and that's why they provide us with premium APIs, because normally it doesn't work that we want to go to the bank and say, okay, we want your premium APIs, we want some extra data. No, this is not the way. And also, yes, in terms of the use cases, absolutely this is the case, that we don't have that much of use cases in Europe, especially in Central and South Europe, like going beyond AIS or PIS. But believe me or not, and we are doing a lot based on IIS already with credit lending financial institutions, and we provide a lot more even without PSD2, because we used, for example, like information about bank account balance to enable credit scoring, to enable like credit lending, some of the decisions. And this financial institutions are coming to us, or ERPs. Maybe I will have some time to elaborate on that. So sorry for letting me to like enrich this and to refer to you, Isidoros.
This is the purpose. We want the conversation. And actually, yesterday, another speaker was on stage, Monica Polemitis, I think, and she was talking about, yes, we do now have the APIs, but the plumbing is not there. The plumbing, the data are not clean, is not where we want it to be in order to actually use it the way we want to use it. But let's hold that. And I want to ask a question to Valandis and Yiannis. Theo, I'm keeping you for the next chapter, because I have lots of questions there. And because both of you have worked on bridging traditional finance and digital assets, and my question for you is, what has been achieved in bridging that? And I know, Valandis, you're more from the tech side, you're building XMoney that does that. And Yiannis, you have the governance experience and you shaped the regulation. So I would love to hear what has been achieved there, where we are now, and then we're gonna start going and dive into the challenges.
First of all, good morning, everyone. Thanks for being here, and thanks for the question. Actually, what we achieved is pretty simple. I'll actually double down on the previous presentation about MICA. I think the traditional rails and the bridge between the traditional rails and the digital asset economy is there. It's real. It moves money for real users under real rules. Crypto is not, let's say, has evolved. It's not only for trading. We see institutions that are tokenizing digital assets, bonds, credits, treasuries, and that allows us to have fractional shares, quicker settlement, and this is happening directly on chain. So digital asset tokenization. We have hybrid rails, the ones that you referred and that we are working on in XMoney. So a user now can initiate a payment from a blockchain rail, like maybe paying with a stable coin or another cryptocurrency, and can be settled in a fiat rail, like in traditional money, in euros or in USDs or any other currency. And the other way around, like rails are not competing, they are working with each other. And I think the third biggest part that is achieved is the regulatory clarity. Now, for us builders, is obvious. Our perimeter is clear. We know where to stop. We know what to build. And as said before, clarity increases trust, and usually trust leads to greater adoption. So digitalized tokens, bridges between the rails, regulatory clarity. So the question is not really if we can do it, because it's already happening. The question and the thing that we should invest on is how to scale it globally, how to scale it in a compliant way, and how to scale, I'll talk about from the technology perspective, the infrastructure, so that it can be resilient, it can be robust, and it can withstand the load and the traction.
And how to build the trust with the people in order to scale it, right?
Yeah.
Which I'm curious what Yiannis is going to say, because I think the regulation can help in building the trust.
Yeah, actually, we said it many times that the regulations builds up, creates the foundations for and the gateway to develop and be innovative, but at the same time safeguard, your operations, the benefits of your customers, of the people. But I will reply in short with two use cases, which I think it's pretty important. So, which actually link back to your question that how is traditional economy or traditional finance linked to the digital assets, more or less, or to the digital economy. So in the last few weeks, it has been announced by a network of big European banks that they are building up their own stablecoin, which is the bigger evidence of the connectivity between the traditional economy and the digital economy. And it's a good way, it's a good thing which is happening, I think, simply because there have been a lot of efforts. And maybe that's my personal opinion, that that's a part where the MICA regulation created confusion and difficulties for the European businesses, the European investors, and that is related to the governance of stable coins, i.e. they have to be based in Europe, the funding has to come through Europe and all that. Although, just to give you an example, USDT, it's primarily based in Europe. It's SPVs structured in Italy, the money is raised, but USDT is not allowed, pretty much. And the other use case that it's pretty important, and that's something I experience, and that's a request that we get almost on a daily basis from our clients. It's the credit facilities. And credit facilities, not just for the crypto, but also for traditional finance and the payments. That's a big thing. And when we refer to credit facilities, just for the audience, it's not just credit on the money, it's credit also on the assets. So in the crypto, we have the decentralized finance, which is for the crypto, but for the traditional economy, it's the lending facilities, which is getting a lot of traction. And some requests that I got last week, it was to lend actually cryptos in order to leverage their traditional investments to give them essentially margin to buy more stocks and things like that. But also the traditional credit facilities to be able to immediately transfer capital because there is margin requirements for your trading, for your investments, and all that.
Thank you. And with that, Theo, I think I'm going to bring you to bridge everything that we've heard here. With everything that happened with open banking, with blockchain, and all the opportunities that are arising, what are the security challenges that arise? And what's the biggest one that possibly keeps you up at night, or is the one that concerns you the most?
Security becomes much more complicated story now. Okay, if you compare the models that you had, initially you had like a centralized, let's say, database server, whatever, owned by a bank. Then you access it, you get some data, you do some transactions. Now everything is exposed through APIs. So just one vault to protect. Now you have microservices, cloud applications, all these things, risk inherited also by the companies that are building on top of the banks. So attack surface is much greater for the attackers, for the obvious reasons. What is very important is to focus mainly on like strong authentication of the users now. Companies that built on top of these APIs to be like security compliant, following some frameworks, doing some testings, and much more work for the security companies.
And actually, can you also add a bit, what's the impact on the consumers? The security concerns that you have, how it's also should affect us?
It's a higher risk situation because as the surface gets bigger, the risk for the users becomes bigger also, right? Because, I mean, you can have their data going through different applications, either for lending or buy now through some apps or whatever. More opportunity for the attacker to try to impersonate them or phish them or attack the API or any type of attack.
What should companies be doing more to make it?
Now they're. I guess they already do
APIs.
that because security is is something which is quite old now. It should be taken as a commodity. I guess everybody should invest, build security measures. Now with blockchain, story is much more complicated because now we are talking about systems surface. In blockchain, you have other type of attacks also. It's a much more complicated system. There, you don't have 100% guarantee that you're secure.
Isidoro, I see you. You want to add?
No, I was gonna go back to 2015. Sorry, but jokes aside, Theo mentioned strong customer authentication, which was, at least to my eyes, the key win of PSD2. And mind you, again, with PSD3, we will see a lot of enhancements upon that. But really, the strong customer authentication was a game changer for payments in general, because before we had the CA, unfortunately, fraud rates and everything was really sky high, and the reliance on catching fraudsters was more on the hands of the institutions and the banks through technology, so that they can preemptively see, which cases are fraudulent or not. But with strong customer authentication, suddenly the cardholder or client or whatever had a stake on the security because they had to go through the extra step. And mind you, PSD2 had a lot of gaps. One of those gaps, believe it or not, it's still being discussed between ECB and Apple regarding Apple Pay. Apple, for some particular reason, still uses SMS, which is mind-blowing for 2025, but whatever. With PSD3, this is changing because we're getting into biometrics and enhanced due diligence in terms of security. So that's my 2 cents.
Okay, I was just checking if you're gonna add to that.
Biometrics, I mean, this is something that is used from most of the companies, maybe also as a passive sometimes. They use like continuous monitoring of the behavior, not just the fingerprint.
Yeah, yeah.
So that's very important.
So on one hand, we have security challenges and risks rising, and on the other hand, we have infrastructure. And right before we heard Andreas in his keynote, he also talked that it's the infrastructure that fails us. So Valandi, I'm looking at you. From a resilience and infrastructure point of view, where are today's systems most fragile, and what should consumers be aware of?
That's a good question. I think the problem is not the technology. I think there are, at least in my mind, 3 or 4 main aspects or main pillars. First of all is cloud congestion. Like before, 10 years before, we had like a small segregated infrastructure. So smaller segregated risk, but now all fintechs and all big banks have moved to the big cloud providers. And we've seen it last week with Cloudflare, like half of the world was down, and we've seen it, I think it was 1 month ago with the US Virginia geographical zone that was down. This is a big risk actually, because it affects millions at once. And yeah, there is a way to protect yourselves. I think, your infrastructure should be able to support multiple geographical zones, and this forces you to introduce some other controls, like the disaster recovery. Your business continuity should be dependent on that. So you should check often that if one zone goes down, then use the other one. So, or even have something that we called in the industry cloud exit strategy, like if something like an asteroid hits, but we will not care about it, but never mind. So I think the cloud concentration is one big risk. The other is the dependency, the chain of dependencies actually, because now in every, let's say, payment, we have 5, 8, 10 calls to internal or external systems. The consumer is not seeing it, but if one of them is slower or one of them is not working, then you have a big problem. So how you can face that is by applying something that we call, it's a technology language, a circuit breaker. So if something is not working, do not use it in the next call. Or how we call it, like bulk heading. Like it's like a ship having watertight compartments. If one is flooded, do not let the water go to the other. So that you can protect yourself, and if something is not working internally, then it's not cascading into the whole flow of your payment or whatever. So the chain of dependencies, the cloud congestion, and I think the third one. We are talking and we are proud about speeding things up and instant, very nice, in SEPA instant or blockchain in millisecond finality. But this is a double-edged sword, I would say, because I call it malicious velocity, because there is an attacker and there is let's say, a vulnerability in a system. And before today's technology, an attacker would get, let's say, X millions in 2 days. But now it can get it instantly. So this is a very big problem, actually. And I'm not sure how we should face it. Probably increasing observability, increasing visibility, AI, because a human cannot detect this kind of patterns. So yeah, I think those 3 are the main, say, pillars in my mind that I see the most risk.
And although AI can help with some of those risks, AI is also used
Introducing new risks.
to increase the risks.
Chicken and the egg problem.
Yeah, so absolutely, but this is a very common truth that every technology, every single technology can be used for good and for bad.
Yeah.
So absolutely, with the increasing AI application, the AI technologies applications and use cases, of course, we have like AI for compliance, for risk management, for fraud prevention and detection. And of course, we can use it in a powerful way. But on the other hand, exactly, this is AI that really causes a lot of like deep fakes and of course fraud again and any attacks and so on. But I'm very much like aligned with Valentis, but also Theo mentioned that at some points because it really resonates with me being in the industry for 25 years. So we really, and I have been witnessing like how much of the complexity we are adding to the equation, and of course, and then on top of the pace, like we are talking about instant payments, instant data. So basically, yes, there are so many challenges, but with the complexity, we add another layer of architecture with the complexity of data, of course, but also with the regulatory complexity, because regulatory and regulations are good, but also they are, again, they are not user-friendly. And also something that I see, and I would like to highlight here is, okay, we have to be compliant, and my company is compliant. We are regulated. We are licensed by the ACPR in France, which is like the equivalent of FSA, supervisory body for TPPAs and payment institutions. And we can't compromise on security. But of course, we should care about the user experience, about the user journey, and not only consumers, because we do represent SMEs, small and medium companies. So I think this is like a compromise or an arbitrage between the two. And even with the SCA, so strong customer authentication, of course, it adds to security. That's good, and it was very much welcome and awaited by the industry. But on the other hand, I remember the times of old good payments and with the credit card payments with like only two-factor, not two-factor, not even two-factor, one-factor authentication.
Half a factor.
Yes, yes. And then, like, even from my perspective, not only like, you know, just product-driven or strategy-driven person, but user itself. So it's a kind of complicated and sometimes very much annoying. I understand that the security and compliance standing behind it, but of course we can't forget that. And also, so that's why, referring to AI, I'm a big fan of agentic AI, because what it does, it's really, okay, that's an additional layer, and it enables you to automate payments, but everything which is like the key component there, like security, like consented approach is already embedded there, because what agentic AI does is simply like, you know, just taking the intent, the payment intent, and it's executing on behalf of the client. Of course, it can be like instances, it can be like, you know, just set in time and so on, not going into details, but it's a powerful tool, because everything, it's not compromising on security, it's also consented, that the consent has to be there for any credit or open banking payment, but it's there. And maybe like one point to make about the complexity. So of course, agentic AI, whatever it is, if it's Google, if it's PayPal, it really reduces this part of complexity from the user perspective. So it facilitates, streamlines the user experience. But also on top of the complexity, one of the remarks, because as said, I've been so long in the industry, and I remember the times of the private APIs, so APIs that we mentioned here a lot, so like application programming interfaces. So of course the private APIs, they were just set between two companies, and they were private. So this was the way to exchange and extract data. It was quite secure, of course. It was not that complex in terms of the technology architecture as nowadays. And then, of course, like with time, we opened APIs, we made them public, so now you can have access, and you can have access to the API specification, there are sandbox. But who did it? Was it financial industry? Not. It was big techs, all the Googles, all the Facebooks, Microsofts, and of course they had the conferences every time they announced new APIs. This is how they opened the tech world, and then we replicated in a way. So, but I remember it was kind of a safe and easy word. Of course, I just don't want to say it's not positive right now. I'm of course backing the technology very much on top with agentic AI, but of course, yes, it's getting more and more complex, it's getting more and more rapid, and also we should have a kind of a right balance between the security, compliance, and the customer-centric, customer-first approach.
So just, I mean, I'm trying always not to become too technical, even though I come from a technical background, believe it or not. Building upon what the guys were saying regarding the complexity, things that people do not understand because, for example, they want to buy something from a brick-and-mortar shop. Okay, what do? They whip out their mobile phone or the card or whatever, and they do a payment on a POS. They wait for a few seconds, and then that's it. What people don't typically understand that in the back end, you get a message traveling through a network like MasterCard, for example, going to the issuer. Then the issuer themselves are trying to check whether you have the balance or not in their systems. If we're discussing about fintech, that a crypto wallet is employed, then there is a breakdown of the authorization message, partly on the balance of fiat currency and another part on the crypto balance. Now we have seen with ESG and greenwashing, I would say, carbon calculation, emissions for your transactions. So that's another API call. And then you get cardholder empowerment where I can take out my mobile phone and say, cool, I don't want to do transactions on supermarkets and I don't want to do transactions online. This is another check. Now, factor in to all these, things, the fact that you have a maximum 2-second window on the POS to get the authorization for the transaction. Have you waited 2 seconds on a POS? You're looking at it like that, you and the cashier. Obviously, not a good place to be. So yeah, it becomes super, super complex. Anna is spot on, and also Vlad is spot on. There are complexities again and again and again and again. And some, mind you, I mean, I'm not tech anymore, so I can say that. We need to rationalize at some point of time, for sure.
Just describe the chain of dependencies, all the dependencies. Yeah, indeed. And the window is so small, right? It's amazing.
Out of curiosity, what are the some of the fraud patterns that you see now that concern you? Because now with AI, we see more of deepfakes, and this is something that's being discussed now a lot in insurances, in banks.
So very, very quickly, because part of the things that we do is actually eKYC and KYB for onboarding of clients, of customers of our clients. So a lot of deepfakes, like a boatload of deepfakes, photos, videos, documents, I mean, you name it. And at some point of time, because mind you, we do a lot of stuff, but we're not really a KYC provider like, I don't know, SamSub and whatnot. So we try to be compliant and diligent, but it's not our main service line. It really becomes a struggle to get on top of, AI and all the issues that it brings. Yeah, so.
All right, thank you. Well, I have 2 questions related to some of the challenges, and then I want to go to the opportunity. Nobody's stopping me, so I'm going to continue. Yiannis, I have a question for you. From a regulatory and governance perspective, what is the hardest part about connecting decentralized systems with the traditional, tightly regulated financial services?
Actually, it's also a challenge at the same time. Yeah. So it's a problem and a challenge. So I remember back in the days, maybe not even 10 years ago, when we had the launch of other blockchains like Ethereum and then a zillion of other blockchains, the biggest topic of discussion in all of the conferences was the interoperability between the different networks, which is kind of one of the topics today still, as you can imagine, but it's been like 10 years. And interoperability also in the traditional finance world still remains. So there is no interoperability between the institutional world, which is a big, big thing. And that's, I think, the opportunity of AI technologies or blockchain technologies to come and simplify the operations of those institutions. So for us, when we try to offer a variety of different asset classes, of different products that fall under different asset classes for our customers, then we have to connect to different counterparties, use different systems. And that was also a personal challenge I had in the last 1 year, trying to find the magical solution that does pretty much everything, which doesn't exist. And that's where the opportunity lies. Interoperability between the systems, but also going back to the payments and money movements, that's also the other part I was referring to before. For the consumer side of things, which is the cash, most of the times, making sure that the accounts are appropriate for each user, it has the right balances, it reflects the user preferences and all that, but also from the institutional side when we want to provide credit to prove that we own something and things like that.
Thank you. I'm going to ask a question to Theo, and I think I'm going to open a Pandora box. Let's keep this short, this question, and hopefully the audience can ask more follow-up questions on this, because I also want to ask a couple of opportunity-related questions. Quantum.
End of the world.
That's the first one.
So how real is the risk? And how close are we to quantum computers breaking?
Yes, I mean,
cryptography?
we are not talking about risk anymore. We are talking about when it's coming.
Yeah, it's coming for sure.
Yeah, it's coming. We are talking about timelines. They say, I mean, in the European Union said 2030 we should be ready.
2030?
In a few years, 5 years.
30?
30.
32.
Yeah. The thing is that all these systems that we discussed before, authentication, whatever, all are based on cryptography. We have two types of cryptography. The asymmetric one is dead as soon as these quantum computers arrive. And we have to migrate into the new ones that NIST released. Libraries are already there. We know which algorithms to use for which use case. For example, digital signing or for hashing, and these things are pretty much secure. What we should do, start understanding how to get into this new technology. For example, Google Chrome and all these browsers will do this seamlessly for us. We will not understand. They started doing it anyway. But if you maintain a whole infrastructure and you use RSA, elliptic curve, digital signatures, or whatever, all this has to be migrated into the new systems, which is, it might sound easy, but it's not trivial at all. Okay, you have to pretty much mirror everything, maybe try to replace a few of these algorithms, and try to remap everything into the new reality, which takes time and a lot of dependency. Mm-hmm. The good thing is that we have the algorithms. We know which algorithms are going to be used. There are already libraries out there. It's, I would say, the challenge is for very big companies.
The focus is increasing
they already have the systems, they are already have the communication channels to migrate into these new.
Okay. The key component here for the audience to understand is that quantum computing is not far from today. First and foremost, you do get the ongoing contest of big techs of whom will have quantum supremacy, which on its own creates an environment that quantum computing will be established. But it really is here. I remember back in 2018, I was working as a sales director for IBM here in Cyprus. And I remember back then we did provide APIs to direct access to quantum computing from IBM to the Cypriot Oncology Center for obvious reasons. So, and now we have 2025, and Theo said it all, right? 2030. So,
if you also go and see the research that the big companies are doing, I mean, it goes like the normal exponential curve, right?
Yeah.
More and more qubits are out until you have enough qubits to do the computations, and then you have a quantum machine.
I also want to add two things. The first, and I want Theo maybe to confirm, is that no blockchain is quantum safe right now. Is that correct?
The main security is the keys. The keys are based on elliptic curve digital signatures, which is not secure, but they will run migration.
Exactly. And some blockchains are far ahead, so I think some of them can get away with some minor patches, but some, and even big ones, are not there. So they might need bigger migrations. So thanks for confirming, because yeah, this is something that nobody is talking about. I think blockchains are not quantum safe now, but they will be and they should be.
If I may add something, if there is a state, let's say, that captures all the data, what you do on the internet and just keep them in a data center, they can decrypt everything in a few years. Yeah. This will happen, you cannot prevent it, it's done. So it's from some years later what we can do.
And that's the second thing that I want to add is what companies can do. I normally say to the teams, I talk about quantum agility. So you cannot do a lot of things right now, but what you can do is monitor where your keys are, monitor when you're saving the important data, and write them down, and then run some exercise to rotate, for example, some keys. Be ready to do the change when it's needed, because I think that's the real risk for the companies. If you are not ready and something comes fast, then yeah, you don't have the time or it disrupts your strategic plan. But if you are ready, like similar to the disaster recovery, just check your keys, your perimeter, and be quantum agile. I think it will help you in the future, and it will help you adopt faster in the future.
All right, thank you. In a few minutes, we're going to open questions for the audience. Do I have 5 minutes? No? But because, right now, we ask a lot of challenges questions. I want to ask at least one question around opportunities, just to bring it up on the where the money goes. Last question. Oh, gosh. And I have a question for each one of you. All right. Here's one. In the current market, I have this for Anna, but I think anybody can jump in as well. If you could wave a magic wand, which parts of embedded finance would you boost and which parts would you minimize?
Oh yeah, so thank you for this question, Maria. Of course, if we are talking about the embedded finance is everywhere, because this is how, of course, like payments or any other financial services are empowering other sectors. If you look at the e-commerce, it's clear. We have also gaming, real estate, travel. So all these sectors, especially like online sectors, are empowered by the embedded finance, because there is always like a checkout, there is always like a kind of a customer journey now, even like a smart checkout or instant checkout. Oh yeah, they call it like smart checkout, because you can go directly to the checkout, to your card, instead of doing this kind of a journey through all these steps and so on. So I would say that this is everywhere, and I couldn't like pick up one. And of course, if I'm talking about open finance, which is related to embedded finance, but of course, like this is mostly about the data. So I would definitely pick up some of the SMEs focus use cases, and this is what we are also doing at Bridge API. This is credit lending, this is credit scoring, this is all credit facility related, even BNPL, B2B, that really have been growing a lot, and business finance management. So we already have some use cases that we can prove. Of course, this is the kind of initial milestones, and of course, this is the top of the iceberg. But yes, if we are talking about the future is open.
Yes, and anybody else who wants to add on this? And then
just as a final remark on my end, what I expect is to go digital, to go on blockchain based if it's possible, just to avoid all of this hassle of the middle office, of the operational aspects, of the risks, complexities that we have. So I think going digital, either for the payments or for the operations, that's my biggest wish, at least.
Thank you so much.
Yeah, from the technology, I should be invisible actually, and let consumers follow the journey that really makes technology invisible, like agnostic.
All right, and with that, we can take a couple of questions. Something I didn't ask, I'm just going to say it so the audience can also know. I think most of the panelists are also involved in investments, and they do either due diligence or they invest themselves in groups. So please do ask any questions you want.
The audience is actually helping me out. Thank you.
I was about to say I have more questions, but maybe...
No, thank you.
Thank
you very much.
Thank you so much. Thank you,
Thank you, guys.
Thank you, Maria. Thank you.